Howdy, y'all. Welcome back. It's the weekly economic update for August 23rd, 2021. Hope everyone had a fantastic weekend. It's pretty nice here in Colorado. Got some chores done out in the garage and got some weeds trimmed. So definitely was a productive weekend, at least from that point of view. So let's go ahead and jump into the weekly update. Let me make that a little bigger for you so you can see it. All right. So the week on Wall Street, stocks turned lower last week amid the increasing possibility of Fed tapering, mixed economic data, and growing concerns about the economic impact of the Delta variant. The Dow Jones Industrial Average slumped 1.11. The S&P 500 lost 0.59. The NASDAQ slipped 0.73. And international surrendered 2.94%. So definitely was the roughest week overseas. Looks like the S&P was probably the best of those four indexes. All right. Next headline: unsettling news. After the Dow Jones and S&P 500 index climbed to new record highs to begin the week, stocks pulled back amid weaker than expected retail sales, festering concerns about the Delta variant, and slowing growth in China. The stock market retreat accelerated midweek with the release of the FOMC meeting minutes, which signaled that Fed officials may be ready to begin reducing its monthly bond purchases before the end of the year. Stocks managed to stabilize on Friday, pairing some of the week's losses. Consumer staples, healthcare, real estate, and utilities were the top performing groups. All right. He suggested that the economy was strong enough to justify tapering the Fed's monthly bond purchases. Last week, that chorus grew a bit louder with the release of minutes from July's FOMC meeting. The precise timing was left undecided, with some officials believing that it could be before year end, while others, though, thought waiting until the start of the new year was a better choice. We'll see. All right, we got economic data coming out this week. Today, we have existing home sales and PMI composite flash. We have new home sales tomorrow, Wednesday, durable goods orders, Thursday, jobless claims and GDP, and Friday is consumer sentiment. Companies reporting earnings, we have JD.com, Palo Alto Networks today. Tomorrow is Best Buy and Intuit. Wednesday, Salesforce, Ulta Beauty, and Autodesk. Thursday, Marvel Technology, Workday, Dollar Tree, Dell Technologies, VMware, and Peloton. All right, so that's the basic news in my weekly update. I have a few white papers going out this week. The first one's titled Distracted America, Consumer Habits Are Changing as We Spend More Time at Home. Basically, with the pandemic over the last year, people have been spending more time in their houses, and just three major categories where we've seen some major increases in consumer spending. Movies, subscription streaming rose by 21% to $12.2 billion in the first 6 months of this year. Gaming, video game stores at brick and mortar stores hit $5.6 billion in March, an 18% increase over a year ago. And digital sales are expected to push this startling figure even higher. And takeout, excuse me, due to the increased number of people ordering takeout and eating at home, says that the online delivery food services market is expected to grow from $115 billion last year to $126 billion this year. So people are spending money on things at home. All right. And then the next one is the Fed can't keep a secret. Are the Fed president's tails out of school? This is an expansion on what we just talked about a little bit. And I'll go ahead and read through this for you. If you have a secret, don't tell anyone at the Federal Reserve Bank. They may leak the story before you like. In early August, multiple regional Federal Reserve Bank presidents hit the speaking tour. They made headlines by suggesting that the economy is strong enough to justify tapering the Fed's monthly bond purchases. As you remember, the Fed began buying $120 billion in Treasury and mortgage-backed securities in July of 2020 to help support the economy. But now it appears that Fed presidents were just telling tales out of school. As At its July 27th, 28 meeting, most Fed members agreed that looking ahead, provided that the economy were to evolve broadly as they anticipated, it could be appropriate to start reducing the pace of asset purchases this year. These minutes are from the meeting on August 18th. Financial markets appeared to take the news in stride, thanks no small part to the Fed president's hinting at a policy change. In the coming weeks, we're likely to hear more from the Federal Reserve. On Thursday, August 26th, central bankers will meet virtually for their annual Jackson Hole Economic Policy Symposium, where Fed officials are expected to guide when they could begin to pare back bond purchases. All right, so this is something I've talked about a lot, in meetings, in these videos over the last few months, that the Fed what the Fed's been doing by purchasing up all these assets is they've been inflating the economy, inflating the money supply, and leading to the cost hikes that we've seen, whether or not it's at the pump, at the grocery store, for energy prices. So we'll see where that goes. All right. Some good news. This comes from First Trust. July existing home sales. Existing home sales increased 2% in July to a 5.99 million annual rate, beating the consensus expected at 5.83 million. Sales are up 1.5% versus a year ago. Sales in July rose in the Midwest, West, South, but remained unchanged in the Northeast. The gain was entirely due to single-family homes. Sales of condos and co-ops fell in July. The median price of an existing home fell to $359,000 in July, not seasonally adjusted, but is up 17.8% versus a year ago. Average prices are up 12% versus last year. So prices are up, homes are still selling. So from that aspect of the economy, people still have the means to go out and purchase new homes, move from place to place. So from that perspective, the home sales market looks pretty good. All right. Next, just wanted to read a few bits out of here, out of the weekly commentary from end of last week. Starts out, longer dated Treasury yields fell last week as the August 18th Federal Reserve Board and FOMC July 28 meeting minutes were released. They discussed economic progress in light of COVID and noted that impacted sectors are improved but not yet fully recovered. They commented that inflation has risen, largely reflecting transitory factors. There's that word again, transitory. The board feels the board feels that financial conditions remain accommodative and intends to continue pursuing accommodative policy until inflation is moderately above 2% has been experienced, such that inflation averaged 2% over time. It does not insist that inflation expectations remain well anchored at 2%. It was such conditions that left key rates unchanged. All right. Regarding asset purchases, the committee discussed that it currently purchases $80 billion a month of Treasury securities and $40 billion a month of agency mortgage-backed securities. Since the December increase to the above rate, the committee has observed that the economy has made progress towards these goals, inflation and employment, and the committee will continue to assess progress in the coming meetings. So there's that. All right. And then one last article I wanted to read. This comes from Brian Westbury, the chief economist of First Trust. The article is titled Fed Being Tempted into Sin. And this starts out talking a lot about the situation we had back in the 70s, leading to the inflation that we had through the 70s and the beginning of the 80s. All right, starts out, narratives get more energy these days because of social media and cable TV, but they've always existed. Back in the 1970s, one narrative was that inflation was not caused by too much money creation by the Fed, as Milton Friedman argued. Instead, it was caused by OPEC or inflation expectations. And politicians came up with a plan. It proved disastrous. All right. In October of 1974, I was 8 months old. I had no part of this. In October of 1974, with inflation running at 12%, not a typo. President Ford announced a plan to whip inflation now, which was supposed to reduce inflation, not by tightening monetary policy, but by changing consumer habits. Consumers were encouraged to wear win buttons. The good news was that with this approach, was a more free market method than the government-enforced wage and price controls under President Nixon. The bad news was that by ignoring monetary policy as the ultimate source of inflation, it was destined to fail. The theory behind the Win campaign was that inflation was caused by consumers spending too much money. So reducing inflation required consumers to save more, spend less by, for example, growing their own vegetables, carpooling, using less energy in their homes. The idea was that changing consumer spending habits would wrestle inflation under control. It's easy to look back now and laugh at this absurd attempt to reduce inflation. Alan Greenspan, who worked for Ford in the White House, wrote in his book, The Age of Turbulence, that at the time he was thinking, this is unbelievably stupid. Well, he was right about that. These days, it appears that the Fed has come full circle and is trying to create more inflation. We decided to give a campaign a smart name. Start inflation now. Maybe the Fed should start printing sin buttons. So that's where the sin comes from in the title. That, in a nutshell, is the policy proposal proposed by David Wilcox, a former influential research director at the Federal Reserve, and David Reffenschneider, a former Fed economist and advisor to Treasury Secretary Janet Yellen, who backs the reappointment of Jerome Powell. In particular, Wilcox and Reffenschneider want the Fed to raise its inflation, its 2% inflation target to 3%. Great, we need more inflation, which would let the central bank run looser monetary policy. They believe looser monetary policy would help create more jobs, reduce unemployment, and even reduce racial inequities. I don't know how racial inequities have anything to do with inflation, but hey, it's it's the progressives who are running the government right now. They seem very concerned about bullshit like that. We think consistently higher inflation is a bad idea. Printing more money is not the path to sustainable prosperity. Higher inflation would make business planning more difficult and reduce the real inflation-adjusted wages of workers, particularly those who with the least bargaining power, including lower income workers and, quite frankly, retirees. Over the last 15 years, I've done hundreds of retirement plans for my clients. And, if inflation is now going to be 3, 4, 5%, completely screws everything up. It means that someone who, was just barely going to make it to, say, age 100, might run out of money in their 80s. So that's that's the concern I have from my perspective. If oil is more expensive, things like that, that's just going to happen. But when you plan your whole life and then you get kicked in the nuts, it just seems kind of unfair. Nevertheless, we think that higher inflation target is being discussed internally at the Fed, which means it is that even though the Fed is talking about tapering, it is highly likely to maintain a far easier monetary policy than what otherwise is warranted. Even if the Fed moves towards tapering its bond buying, short-term interest rates will still be near zero. The Fed is still going to be loose even when QE is done. For now, the Fed is still says it expects inflation at about 2% next year, as well as in the years beyond. I don't know how they can really calculate that, especially with the dollar create. I haven't looked at the Fred website in the last couple of weeks, but I imagine it's still pushing $20 trillion. For now, the Fed says it's still. I read that. We think inflation will be higher than next year, and if the Fed doesn't explicitly reject the idea of the new higher 3% target, may be higher for many years to come. Money is a contract between government and the people. A stable currency is essential for a stable economy. With the M2 measure of money now 33% higher than it was that's what I was just talking about, in February of 2020, total spending minus prices plus real output will end up 33% higher. That doesn't mean 33% increase in the CPI. After all, productivity is growing. But this is extra money that the U.S. economy has absorbed since the 1970s. We may have more than one book written by advisors in D.C. today that will echo what Alan Greenspan thought back in the 1970s. Narratives work for political entities in the short run, but often lead to disastrous outcomes over time. We'll be watching for the new sin policy closely in the years ahead. So it's a bit over, over the years, but we'll see where it goes. And I would strongly suggest diversifying your cash. If that's not financial advice, let me stop right there. But just educate yourself on the other forms of preservation of wealth out there that you can use, so that if, say, we have a dollar crash or a crash in other currencies around the world, you won't be hit so hard in your wallet. So, all right, well, let me close that, and that's everything I had for the weekly update. If anyone needs anything from me, feel free to reach out to me. Phone call, email, smoke signals. Be sure to like, share, and subscribe with your friends and family. And I'll be back on Friday with the weekly wrap up. So if anyone needs anything from me in the meantime, feel free to give me a buzz. Hope you have a good day, and I'll talk to you soon. Bye-bye.